Hi guys, we had a awesome Tuesday night podcast this week. We couldn't get to all of your questions, and that's why we're going to do a little video right now and address some of them that we couldn't get to.
We have another video we'll post in a couple days where Jay Powell faced Congress, and a lot of people thought that the Fed was going to pivot and reduce interest rates, and the exact opposite is happening. So let's dive in.
Yeah, we can sense the frustration that many of you have. We had Jeff M. make a comment. If you purchased a home in the last 2 years, you can make $40,000 to $60,000 and live a comfy life. If you didn't purchase, you need to make $100K a year just to rent and live in poverty. Obviously, he's talking about the interest rates here.
Yeah, Jeff M., he's a regular commenter on our podcast. I think what Jeff is probably saying that if you purchased prior to 2 years ago, would even have been much better. The last 2 years, though, interest rates have been extremely low. We watched 20% year over year home price increases in most of the markets throughout the United States. But now with the house prices where they are right now, interest rates have definitely knocked a lot of buyers out of the market. And I don't think that's going to change anytime soon. As we're making this video, I think 30-year mortgage rates, average fixed rate mortgages are definitely in the sevens with really good credit. I think if you are below a 700 credit score, you may even be in the eights, depending on how much money you're putting down. But I do feel, with Jay Powell facing Congress and basically saying that they're not pivoting, I believe that interest rates will go up from here. I think that I will not be surprised to see interest rates 8.5% by the end of 23.
So let's bring it back to Jay Powell. We had Lex C have a question. What is your prediction if these rates stay high? Jerome doesn't seem as dovish anymore.
My prediction, just as I had mentioned, I think we'll see mortgage rates, the 30-year fixed mortgage rate, at least at 8.5% by the end of 23. Again, I mean, no one has a crystal ball, but I think that sevens will be here to stay. I think over the last, 40, 50 years, we've averaged in the 7% 30-year mortgage interest rate. So I think that we will be back at that. I don't think we're going to see 4% again. When we get to 8.5%, and it drops back to 7%, it will seem like a rebate. But I think that what this means for the housing market is that prices will come down significantly. I think that housing is unaffordable for most of the home buyers. Nationwide, most of the home buyers over the last several of years have been the first-time buyer, over 30%, in fact. And then we have another 30% plus of the buyers nationwide were investors. This really helped to bid up home pricing with the low interest rates and cheap money. But I think that now that we see that money isn't cheap anymore, we're going to see it impact home prices because people simply can't afford the mortgage payment on their current wages. And that's a problem. We haven't seen wage growth increase over the last decade or so. It's been very nominal compared to, the rate of inflation. It could go the other way too. It could just, we could see, 80s type of stagflation where the demand drops off, the house prices kind of stay where they are and stay high, but we see the demand drop, and we may just experience people staying put instead of selling their houses.
Mm-hmm. And I think that we go right into another watcher who had, a lot of stress and strain and not knowing what to do. Fleur Henrice made a comment. I tried to gauge between paying high price with low rate and still high price with high interest. Don't know what to do now.
I think one of the things lenders tell us about buying houses is to date the rate and marry the house. And, what they mean by that is, don't fall in love with your rate. You can refinance. And, I think that this is really misleading to a lot of buyers because, most people, especially first-time buyers, they don't stay in the house very long. They're staying in a home for, a temporary basis. They're buying a home that they can afford now. And many of these buyers, they want to move when their life makes a change, when they, get married or have children and, they want to upsize. They'll start out with a smaller house, maybe a townhouse, and wish to go into a single family house. And so I think these types of buyers want to stay in a house for 5 years or less. So the problem with paying top dollar for the house is now that we're starting to see prices come down, they're underwater with their home price, where they will probably need to bring money to the table in order to sell. So in this case, it really isn't a matter of dating the rate. And something else that lenders don't tell borrowers a lot of times is that, it is expensive refinancing. So if you're dating that rate and you go to refinance when interest rates drop a point, if you're not planning to stay in that house for a very long period of time, the costs of refinancing, you really don't make it as advantageous to do so. It makes the lenders more wealthy, and it definitely helps the appraisers that get to come and reappraise your home. But I don't always think it's in the best interest to refinance. So I think what I would say is, home price is the most important, in my opinion, especially when you're looking at a home as an actual investment. And, and along with that comes a home that has been well inspected and that you are well aware of the work the home needs. Because for many of these buyers in the last 2 years, they overpaid for the home. They didn't have a home inspection. And now they're finding that they can't afford to make these costly repairs.
So let's talk more about the interest rates, because we did have a question from Jordan Bressler. Jordan said, does inflation in the cost of money, interest rates, count as inflation?
I guess in a sense, technically higher interest rates would be inflation to interest rates. But when I think about interest rates, I think about debt, right? I think about taking a product such as a house, or whether you're using your credit card to buy something and then paying a lot more for that product as a result because of interest rates. So I think that, we rely too much on debt as Americans, and I don't know who said that debt was a good thing. I try and live by, I'll use my credit card to make it convenient to buy something, but I only like to buy things that I can pay off. And I get it, guys. I mean, most people can't go out and pay cash for a house. And if they can afford to pay cash for a house, they don't want that house. They want a house that they can't afford or that they can make, payments on, just like a car. We see people financing cars for 7 years now. And I mean, they could probably pay cash for a car. Maybe it's a $5,000 car that they just don't want to drive. But what they also don't realize is how often are they in that car? I mean, if we looked at, how little we drive our automobiles, they sit in the driveway, they sit in a parking lot at a store, or they sit in a parking lot at work. So I think it really comes down to buying what we can afford and something that we can pay off quicker than what the term of the loan entails. And before we go on to the next question, I want to kind of segue into, the point about the car, right? So a lot of people are buying houses and they don't spend a whole lot of time in the house either. So, I know prior to the pandemic, we do have a lot of people now that work remotely. They're calling a lot more people back into the office. But, I can't tell you the amount of people that live in an oversized house that are gone from morning until night, right? And so they never really see their house. They only live in 2 or 3 rooms. So, I think it's, more of we've set ourselves up for like the status, quota where we have to look a certain way or live in a certain community or things like that. And it's taken us into debt. And I think this is a major problem. So I think we might see one of the largest recessions we have ever seen in the history of the United States. And it just may be now. We may just be at the beginning of it. And I think we're going to learn some very valuable lessons, just like my grandparents did going through the Great Depression.
As you said, Todd, I mean, this is definitely the time to be smarter with your money. And Danuska had a very good question. She said, Todd, in this current time, would you advise paying more on the principal by making your monthly mortgage payment?
And this is another great point. So, what I would say, Danuska, is, depending on how long, I mean, you're in the house right now, you have a mortgage payment that you can afford. There's 2 things at play right now, right? Number one, you want to make sure that you don't deplete your cash, because should you go through some type of unplanned financial hardship, you want to make sure that you have enough cash in the bank that can sustain, a 6-month period of paying your bills. And, a lot of people will think if they deplete their cash, they can just get a HELOC on their house, or they can just use a credit card to get quick cash and things like that. But if, you happen to lose your job and you've depleted all your cash, you're not necessarily going to get a HELOC on your home with no job. So I would say, make sure you're keeping 6 months of emergency cash on hand. And then if you have an excessive amount and you're paying a high interest rate, maybe 6-7%, and you're not able to put your cash into something stable that will earn you 6 or 7%, then definitely buy down your note, pay more on your principal. You're going to get that back anyway if you do sell your house. And, so you'll get that cash back, but at least it protects your money. And, instead of paying 7% or 7.5% interest, you'll be earning it on the extra money that you put down to reduce your principal payment.
Mm-hmm. So let's talk about, writing an offer. And we had a question come in. What would be considered a good lowball offer in this climate? And what would be considered insulting? Does market location matter?
And this is a great question. We get it all the time. What should you offer when you're buying a house? And depending on what market you're living in, we are still seeing some markets in the U.S., and we just looked at Reston, Virginia yesterday, where we've seen the 90-day running median price has gone up significantly just since last year. And we look at other markets where we're seeing 20% declines, price declines. A lot of this is predicated on inventory and the demand to live there. And so, you may be thinking that it's time to do lowball offers, and you're just going to be turned down every single time if you're in one of these, markets that still have very high buyer demand. So I think, really look at your current situation. Are you leasing right now? Do you have a house to sell? Do you need to move? Because there's a lot of costs that are associated with moving. If you're renting, you may want to wait another 5 or 6 months, get yourself into the fall or the winter market, see what's happening with the economy. I think that the Fed is definitely going to raise rates again here this month. I think we're going to see a 0.5 point hike in interest rates. This is going to really rock our economy. And I think that there will be a lot of sellers that will need to sell. And there is a question, Melissa, that I do want to take, that goes along with this, that addresses the lag. Mm-hmm. What kind of a lag effect does, hearing these types of reports, these types of, commentaries that, we're saying, hold off, prices are still going to drop, they're still going to go down. I base this on my experience. I'm not an economist, but I know, working with people and being a consumer myself and being in the real estate business for over 30 years in one aspect or another, serving the housing market, more specifically, I know that people just can't afford to buy right now. We're seeing, educated people, graduating colleges with master degrees, we're seeing, people coming out with, doctorates. We're seeing people graduating with MBAs, and they're living in cities where they're working and they can't afford to buy unless they are teamed up with a partner or significant other, a spouse. Affordability is just out the window, even if they make $100,000 a year. So, I just based on that alone and not expecting any type of significant wage growth over the next several of years only tells me that people that need to sell their houses, or they're going to need to drop the prices at some point. And I think once these buyers start really getting impacted even further by rate hikes and inflation, I don't care what you're hearing, I'm not seeing inflation cooling down. I'm a consumer. I go to the grocery store. It's ridiculous what I get in my bag for $100. So I think, this is where, I'm coming from. This is an angle that I'm coming from, where I still believe that we will see significant price declines.
Mm-hmm. And finally, we'll talk about that lag effect question. When will the lag effect hit us and lower prices more substantially?
And if you look up the term lag effect, basically it means, the time from when you start hearing something and continually hearing it before we see a difference. And I think, that's what this, viewer is asking here. How much time do we actually need to hear that the sky is falling before we realize it or we start to act like it is? And, and I have a video on, the buyers are not allowing the housing market to cool off. And I think that we are still dealing with a very strong job market in most of the U.S. cities, a lot of the major markets in the U.S. anyway, and, where people are feeling like they can afford the payment. But I think that we have an education issue, that we're not educating buyers enough on the cost of ownership, the other costs involved with owning a home. And so I think that, the lag effect is that now people are going to start seeing less of their net income after taxes going to things that they like to do because they're going to be absorbed. This extra money is going to be absorbed with the cost of actual living. So I think that when it starts to hit home with these buyers that, hey, I'm going to have this much mortgage payment. I'm going to have this much in, utilities, taxes, insurance, and all of these repairs that I may need to do to the house, cutting the grass that I never expected or never fully I heard but didn't understand it. I think once we start seeing people losing their houses, not being able to sell their homes to pay off their mortgages, we may be 6 months, a year before we start hearing it from our peers. I think then we'll see the major effect. So, reduction in household cash, reduction in their ability to save money, and just not being able to do what they want to do is going to, wake them up and make them realize that they can't afford to buy.
Mm-hmm. And there you have it, guys. Thank you so much for watching this video, and thank you so much for tuning into our Tuesday night podcast.
And if you haven't already done so, go ahead and subscribe to our channel and smash that alert bell, guys. You'll know every time we upload content like this. And I want to plug our new real estate agent channel. It is all the way down below in the Sachs Realty channel. If you are an agent or anyone serving the industry as a professional, you may want to subscribe to that. We have some great interviews and great content coming your way.
We always appreciate your comments and questions, so keep those coming.
And if you liked the video, you can let Melissa and I know that you did by also smashing that thumbs up. See you next time.
See you next time.
Sachs Realty, Maryland broker number 607720, office number 443-318-4514, equal housing opportunity.